Hello students and welcome to this session of cross-border transactions. Cross-border transactions are those business activities or financial transactions where two or more countries are involved. In context of Indian company law, these could include mergers, acquisitions, investments and payments between an Indian company and any other foreign company. While studying about cross-border transactions, we can also include foreign companies. So basically in this video, we will be learning what the Companies Act says about cross borders in acquisitions. Also, we will be learning about foreign companies. Section 230 to Section 240 of the Companies Act contains provisions related to compromise, arrangements, amalgamations, mergers related to corporate restructuring of small companies and also cross-border mergers and takeovers. The Foreign Exchange Management, that is Cross-Border Merger Regulations 2018, were notified through notification number FEMA 389/2018-RB on 20th March 2018 and came into effect from the same date. So, how can a merger happen as per this act? A merger can happen in two ways. First, a cross-border merger in which the resultant company is an Indian company. Secondly, a cross-border merger in which the resultant company is a foreign company. According to the regulations, merger transactions that comply with these provisions as mentioned in the Act are considered to have received automatic approval from the Reserve Bank of India and no separate approval is needed. However, for the transactions that do not meet the regulatory conditions, prior approval from the Reserve Bank of India is required. The corporate restructuring process in India is primarily governed by the Companies Act 2013 and the Companies Compromise Arrangements and Amalgamation Rule 2016. It also involves compliance with several other key laws including Income Tax Act, Competition Act and the FEMA, that is Foreign Exchange Management Act. Section 234 subsection 2 of Companies Act states that subject to other applicable laws, a foreign company can merge with an Indian company or vice versa with prior approval from the Reserve Bank of India. The merger scheme for such a type of merger may include terms for paying consideration to the shareholder of the merger company in cash, depository receipts or a combination of both as outlined in the approved scheme. Section 234 subsection 1 of Companies Act states that the provisions of this particular chapter will apply mutatis mutandis, meaning with necessary changes to mergers and amalgamations between Indian companies and foreign companies incorporated in countries notified by the central government. The central government may also, in consultation with the Reserve Bank of India, make rules to govern such cross-border mergers and amalgamation under this section. Now, let us look at the rule 25A of the Companies Compromise Arrangements and Amalgamation Rules 2016. There are 4 points given here. Let us begin with the first point. A foreign company which is incorporated outside India can merge with an Indian company after obtaining prior approval of the Reserve Bank of India and also after complying with the provisions of Section 230 to Section 232. Similarly, a company can merge with a foreign company incorporated in any of the jurisdiction which is provided in Annexure B after obtaining the prior approval of Reserve Bank of India and fulfilling the compliances of Section 230 to Section 232. In this case, the company must ensure that the valuation is carried out by professionals who are members of a recognized professional body. Also, the valuation should follow internationally accepted accounting and valuation standards. a declaration should be made and filed with the Reserve Bank of India. Thirdly, the concerned company should file an application before the tribunal and obtain approvals. And finally, if an Indian company is entering into a compromise arrangement, merger or demerger with a company or body corporate incorporated in a country that shares a land border with India, a declaration in form number CAA 16 must be submitted along with this application to do so. As I already told you, this video will also cover foreign companies according to the Companies Act of 2013. Let us see what is the meaning of foreign company and what are the applications of the Companies Act to it. According to Section 2, subsection 42, foreign company means any company or body corporate which is incorporated outside India and which has a place of business in India, whether itself or through an agent, physically or through some electronic mode, and it conducts any business activity in India in any other manner. Let me give you some examples here. A company called Bright Media Private Limited, which is an Indian company, and it has a foreign subsidiary called Skynet Global Limited, which provides digital content delivery services, will be covered under the definition of foreign company. Another example of a foreign company could be of an airline company which operates through its booking agents in India. Let us see now the application of Act to foreign companies. The provisions of Section 380 to 386 along with Sections 392 and 393 of the Companies Act are applicable to all foreign companies. This means that all the foreign companies should follow these provisions. The second point is the requirement of holding paid up share capital. This means a company will be considered as a foreign company where not less than 50% of the paid up share capital of a foreign company incorporated outside India is held by one or more citizens of India or by one or more companies or body corporate incorporated in India, whether individually or collectively. Every foreign company within 30 days of establishment of its place of business in India should give the registrar a few important documents like its memorandum, articles, documents related to its registered office, list of directors, secretary of the company, and so on. The complete address of the registered office in India and abroad should be also filed with the registrar. Every foreign company is required to make a balance sheet and profit and loss account in the prescribed forms and deliver a copy of those documents to the registrar. Rules related to prospectus, debentures, annual returns, books of accounts, inspections are all applicable to the foreign companies. If a foreign company makes any default, there are punishments laid in the Companies Act in the form of heavy fines. So you see how the Ministry of Corporate Affairs have put everything in place for cross-border transactions. So students, this was all about foreign companies and cross-border transactions. Thank you for listening.